The Bank of Canada just raised their interest rates 0.75%, or some people call it 75 bips. And oh boy, are we going to be in for a bloodbath. You have to keep in mind, we started the year at 0.25. We are now at 3.25, which by my math is 13 times what it was originally. And that is a really big rate hike. So a lot of people are going to be talking about the trigger rates because this is the mammoth rate hike, 75 bips that are going to cause some trigger rates to happen, what it's going to mean for the market, what to expect in the short term. I'm going to break it all down for you in this reaction video for the Bank of Canada's monster hike. Now, because there's a lot of fear that will be caused and induced into this, if you're trying to figure out what to do in the real estate market, whether you're buying, selling, or investing, you're more than welcome to book a strategy call with me to kind of navigate this just with the Bank of Canada's interest rate. And you can do so by booking a call with me using the link on the screen. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me. And then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zen and I run a RE/MAX in the Greater Toronto area on top of making awesome real estate content just like this for you. Ooh, yeah, 0.75%. I actually almost thought they should have done 100 just for one reason only, so I could do this in my videos. Like, all jokes aside, this is a big rate hike because 0.75 will cause a lot of people to hit their trigger rate. And there's a lot of people I know that are getting bank calls. I have a lot of clients asking me about what to do depending on what their strategy is. And I'm going to explain the trigger rate first, then I'm explaining the buyer demand and then the listing in that order because it's going to give you a fuller picture of what I think is going to happen. But in short, what's going to happen in the market? I think the 0.75 is going to slow the demand down, but we should still see sales increase and we should still see a very minor average price increase like I was saying in the Market Watch video. Now, what this means for the trigger rates and why I don't think it's going to be a big deal, it's going to be something similar to the mortgage deferral cliff that happened at the end of pandemic after 6 months. There's a lot of banks that are going to allow you to make an interest-only payment and just pay the principal $1 or $2. So you're not going to be extending and increasing your monthly amount that much unless you voluntarily go fixed or you agree to catch up on amortization. What this effectively does is now we're kicking the can down the road on these renewals that are going to happen probably in like 2025, 2026 or so. And we'll see what they're going to do. And most people I know, if they do need to sell, they're like, you know what, why don't I wait it out or try to sell it? And I'll change that monthly payment to interest only and see if I can exit out of this asset. Now, the question is, how many listings are we going to get, right? So that's going to be point number 3. Now, the second point I want to bring up to is buyer demand. Is this 0.75% going to kibosh some demand? I would say yes, it will eliminate some. And I would say most people who are buying right now are end users, meaning they're going to live in their home and they're probably pre-approved using a fixed rate. So now that variable is where fixed is right now. They're kind of the same. They're on par. So on the lowest end, you could probably get a variable and a fixed at like 4.5. On the normal end, you're at 5. So this rate hike for the demand side doesn't change as much as the last one because the last one put you over the stress test over the 5.25%. This one, everyone's already over 5.25, so it's whatever your contract rate is plus 2. So everyone, regardless of the situation, is being stress tested at 6 or 7%, depending on what that contract rate is. So why I don't think the 0.75% is going to be that big of a deal is that buyers are either on fixed or they've been expecting it, right? The Bank of Canada has been telegraphing this. They're like, guys, it's going to be 0.75 and for a long time, right? So any of our clients that have been buying, we're like, look, just expect 0.75. Go get a rate hold anyways on the off chance it's not. This way you have a decision on both sides. But when you're buying right now, you know, you have both options to choose and then you'll be okay, right? So that's kind of on the demand side. I don't think it's going to make that big of a difference. Now, on the supply side, we should be getting a ton of listings next week. So normally in September, we get about 15,000 new listings or so. Now in the year of 2020, in the pandemic, I'll put it up here, we essentially got 20,000 give or take, which is on the higher end, right? But right now, when I last checked this morning on September 8th, we had about 2,300 new listings, which if we're like a third through the month because Labor Day was a little bit late, we're kind of behind, but keep in mind, we're going to get that burst next week on Tuesday, Wednesday, Thursday. And I'll report back then to see how many new listings there are. But at the moment right now, I don't see many new listings coming on the market. And I know from our side on the team and just talking to other realtors, there's a lot of people still buying. So when you kind of loop all of this stuff in together about kind of what's going to happen, I do think the 0.75 interest rate hike is going to drop off demand maybe like 20, 30%. But that doesn't mean that prices are going to come down or sales are going to be down. The seasonal uptick and just the type of assets that get sold in September and October are going to be more expensive because they're more freehold, low-rise properties. That's going to drive the average price up. And the sales will go up just because July and August were so low. So I do think we'll see that uptick just from like a month-to-month comparison. But remember, like I said in the market watch, starting September and October, we'll probably start seeing the year-over-year decline in pricing, which is why I'm saying there's going to be a whole bunch of mixed messages right now. So if you found this content useful, make sure you help me spread the knowledge by smashing that like button and subscribing to the Prime Properties TO channel. And while you're at it, you can share this with your friends who are also following the real estate market. And if you do need some help, you can book a call with me using this link right here. It's www.chatwithzen.com. Now, the last thing I kind of want to touch on is that where are we headed, right? So I'm going to read you a little excerpt that the Bank of Canada kind of like wrote or sent out via Twitter today, I think, right? Because they're active on Twitter now. There's a joke there. So I'm going to read this to you. It says, given the outlook for inflation, the Governing Council still judges that the policy interest rate still need to rise further. So there you go right there. Anyone who's looking at this, the next interest rate announcement is October 26th. Prepare for one more, right? Quantitative tightening is complementing increases to the policy rate. As the effects of tighter monetary policy work through the economy, we will be assessing how much higher the interest rate needs to go to return inflation to the target. The Governing Council remains resolute in its commitment to price stability and will continue to take action as required to achieve 2% inflation rate. So this is why I was saying, like, no one has a crystal ball of what's going to happen with the rates. This is what I think, and I'll repeat myself again. Now that they came out with 75 bips, I do think we'll probably get another one in October, just like they said. But between now and then, there's two things that are going to come out. There's two inflation prints, and we'll probably get an idea of what the GDP numbers look like for Q2, right? So if those numbers and the inflation comes down, maybe they won't be as aggressive. Maybe they'll do 50 or 25 bips and call it a day, right? Or if the numbers don't look as good and the inflation, while it did come down, the core inflation is still high. And they actually say it over here where it says, however, inflation excluding gasoline increased and data indicates further broadening price pressures, particularly in services. So even though like maybe we feel like inflation is coming down, I would not be surprised if the Bank of Canada, who by the way, follows all the other central banks, and if you haven't followed kind of like the global economy right now, Australia just raised their interest rates. The ECB, which is the European Central Bank, also raised their interest rate. It's kind of like they have a WhatsApp group chat, right? So they all raised their rates. This is not new. We all expected it. How much they're going to raise it in the latter half of the fall is to be determined because we don't know what inflation is going to look like. So if inflation doesn't come down dramatically, I would expect another rate hike. So for anyone who thinks that this is the last one, I don't think so. I think we'll expect one more. And this is kind of where we're getting to the should I go fixed or variable if we're expecting one more right now. And that's a video for a different day, or you can just book a strategy call with me and we can chat. So where am I going to end this with is expect a seasonal uptick. So if you're selling, you should get on the market and sell right now. And you may see some softening of the prices come November, December, which has always been the case, right? But where we're going to be in 2023 at the start really just comes down to what the inflation print is. And if we do go into recession and we get cuts of the rate, remember, in a recession, people lose jobs. If they lose jobs, they can't pay mortgages, then they may have to default. So it's not that recession, rates down, prices go up. It's not going to work that way for anyone who's thinking out there. We have to look at all the big picture trends right now, and the workforce is still very tight right now. So that's exactly kind of my take on the short term and the midterm and where I think things are going to be. Now, if you are looking for some help to transact in this real estate market, you can book a call with me using the link on the screen. It's right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.